Accountants think of the balance sheet as a document that tells us the value of what we own and how we paid for it. But that isn't exactly the way a finance person sees the balance sheet. Accounting rules state that we must value our assets as the lower of cost or market. But a financier would like us to value the assets at the current market value. This creates a disconnect between the two professions. Accountants are historians. They look backward and record what happened. If we bought a piece of equipment for $10 million, they would record it as such, then depreciate it over the expected life of the asset to reflect the changing value of the asset as it is consumed by operations. However, a financier would like to carry the asset at market value. In other words, $10 million until the value changes in the marketplace. If the market value of a similar piece of equipment later is shown to be $11 million, then we will have made a decent investment. The accountants will leave the value at $10 million until we sell the equipment later. The financiers will increase the asset value by $1 million to reflect the new, higher value of the asset. The financiers would like to not only value the machinery at the market value of $10 million, but they would like to value it at the higher of that market price or the present value of the cash flows that equipment is likely to generate. After all, if the present value of the future cash flows is more than $10 million, the equipment will provide more benefit than the purchase price of $10 million. That is financial value creation. Accountants, out of conservatism, want to use the lower of cost or market values, while financiers, out of a desire to make better investment decisions, want to value it at the higher of market value or expected future economic benefit. Again, if for any reason either the market value or the present value of future cash flows related to the equipment increases, say above $10 million, then financiers want the balance sheet to reflect the new, higher value of the equipment. These may seem similar, but using the accounting system, the value of the asset shouldn't increase. In fact, the depreciation expense pushes down the carrying value of the asset and on income that reduces retained earnings. In the financial view, if the value of the machinery hasn't actually decreased, it should be carried at the market value, and the residual equity would reflect that. When I say residual equity, I mean the market value of assets less the value of all the liabilities. After all, assets should be valued at what they are truly worth now to the company, not what we paid once upon a time. If we buy an asset that increases in value and our liabilities don't change, then the increase in value accrues to the equity holders. Why? Because the amount we owe our lenders doesn't change in response to the value of our assets. The value of our loans or bonds is fixed up by contract. What does that mean in practical terms? Imagine we buy a company that specializes in digital content distribution and the market for its content takes off. As the revenues and profits for the new division grow, so does the value of the business. Since the liability values are fixed, the change in value accrues to the equity holders. This causes finance people to look at the balance sheet as a series of projects in which we have invested. Good investments will increase in value, driving up the equity value. Bad investments won't increase or might even decrease in value, potentially accruing the losses to the equity holders. Thinking like a financier will help you consider projects as either value-adding or destroying for the business. Thinking like an accountant will help you communicate asset values that are comparable and transparent, reducing the uncertainty of your investments in the eye of the investor. While both balance sheets share some aspects in common, they're used very differently. One for internal strategic planning and the other for external communication to investors.